This presentation is one of the State of Iowa's Retirement Benefit Highlight Series. This short informational video offers valuable information regarding your state of Iowa retiree benefits. This presentation highlights general information regarding retiree health insurance before you are eligible for Medicare, which in most cases is at age 65. Retirees pay the total health insurance premium. As health insurance premiums increase or decrease each year, the premium changes are passed along to retirees under age 65 in the same percentage as employee premiums. The Sick Leave Insurance Program, or SLIP, offers a state retiree an option for using their unused sick leave balance to pay the state share of their group health insurance premiums. A retiring employee's sick leave balance at retirement is converted into a SLIP account. Funds from the retiree SLIP account pays the state share of the health insurance premium. A SLIP retiree pays what active employees pay for health insurance. Funds from the SLIP account can only be used to pay the state share of health insurance only. Funds from the SLIP account can only be used until the retiree becomes eligible for Medicare. A retiring employee sick leave balance is converted into a SLIP account based on their sick leave balance at the time of retirement. If a retiring employee has up to 750 sick leave hours, the conversion rate to SLIP is 60%. If a retiring employee has over 750 up to 1,500 hours of sick leave, the conversion rate to SLIP is 80%. Finally, if a retiring employee has over 1,500 hours of sick leave, all of the employee's sick leave is converted at 100%. There is no maximum number of sick leave hours that can be converted into SLIP. On the last pay warrant, the retiring employee will be paid for time worked during the last pay period, accrued but unused vacation hours, and up to $2,000 from the retiree's sick leave balance. The sick leave payout is mandatory and is taxed based on the retiring employee's W-4. An option for the payout is to direct all or some of the payout to go to the retiring employee's RIC deferred compensation account. In this example, the employee's sick leave balance at retirement is 1,250 hours and her regular rate of pay at retirement is $40 per hour. The first step in calculating SLIP is to multiply her sick leave hours by her regular rate of pay. 1,250 hours multiplied by $40 an hour is $50,000. Next, the $2,000 sick leave payout must be subtracted from the amount, which leaves $48,000. Because the employee has 1,250 hours of sick leave, her conversion factor is 80%. $48,000 multiplied by 80% is $38,400. This is her SLIP account balance. In this example, the employee's sick leave balance at retirement is 760 hours and his regular rate of pay at retirement is $32 per hour. Again, the sick leave hours are multiplied by his regular rate of pay. 760 hours multiplied by $32 per hour is $24,320. Next, the $2,000 sick leave payout is subtracted from the $24,320, leaving $22,320. Does not look at dollars, but at the total number of sick leave hours at retirement. In this case, the conversion factor is 80% because his sick leave balance at retirement is 760 hours. $22,320 multiplied by 80% is $17,856. This is his slip account balance. The DAS benefit website has a calculator which allows employees to estimate their slip account. Enter benefits.iowa.gov in your search engine. At the DAS benefit site, click on Retirees. On the left side navigation, click Sick Leave Insurance Program. And at the Sick Leave Insurance Program webpage is a link to the Sick Leave Insurance Program calculation worksheet. Funds from the retiree slip account pays the state share of the retiree's health insurance, and the slip retiree pays the employee premium. These are the current amounts coming out of a retiree slip account and the amount the retiree pays. If a slip retiree goes from single to family coverage or vice versa, funds from slip automatically pays the state share. When the health insurance premiums change, funds from slip automatically adjust to pay the state share, and the slip retiree pays what the employee premium is for the year. Slip funds are not taxable to the retiree and do not need to be reported when filing taxes. The state pays Wellmark directly its share of the premium from the retiree slip account. The retiree pays Wellmark the employee portion of the premium. Wellmark can send an invoice, or premiums can be taken from a bank account automatically. In the situation where the retiree and spouse are both state employees, in order for the state employee to be eligible for slip, the retiring employee must be the policyholder of health insurance. In the situation where the retiree and spouse are both state employees will have separate slip accounts when they retire. The couple cannot combine their slip accounts. If one state retiree exhausts their slip account, the other spouse can add the state retiree to their coverage. Let's see how slip works. In this example, we calculated the retiree slip account at $38,400. She retired at age 62, which means she has 36 months before being eligible for Medicare. Also, we assume no increase in health insurance premiums during the 36 months. The retiree is enrolled in Iowa Choice Family Coverage. The total monthly premium is $1,804. SLIP pays the state share of $1,624, and the retiree pays $180. This payment arrangement goes on for 23 months. In month 24, her slip account is $1,048, which isn't enough to cover the state share of $1,624. The retiree must make up the difference of $576 plus the retiree share of $180 for a total of $756. The retiree slip account is now exhausted. She is still enrolled in the state's retiree health insurance, but now she must pay the total premium in order to continue coverage. For the next 12 months, the retiree pays $1,804 for Iowa Choice Family Coverage. At the end of 36 months, her slip account has paid approximately 59% of the total premium, and she paid approximately 41% of the total premium. In this example, we calculated the retiree slip account at $17,856. He retired at age 63, which means he has 24 months before being eligible for Medicare. Also, we assume no increase in health insurance premiums during the 24-month period. He is enrolled in Iowa Choice Single Coverage. The total monthly premium is $769. SLIP pays the state share, which is $715, and the retiree pays $54. This process goes on for 24 months. After 24 months, the retiree is now eligible for Medicare and is no longer eligible for SLIP. He still has $669 left in his SLIP account, and this amount is forfeited. When a state retiree has a spouse or domestic partner who is Medicare eligible, the state retiree can still use SLIP funds. Whether someone is Medicare eligible only pertains to the state retiree. A SLIP retiree cannot return to permanent state employment and continue to receive SLIP benefits. A SLIP retiree who wishes to become reemployed with the state in a permanent position waives all current and future SLIP benefits. A retiree is eligible to return to state government once the SLIP benefits cease. A SLIP retiree may be hired in a temporary position for a fixed-term appointment if the hiring authority has received approval from the Department of Administrative Services. Approval will be for a short-term situation only. Long-term continued employment in a temporary status will not be permitted. A SLIP retiree is not prohibited from performing services for the state if the SLIP retiree is an independent contractor, is employed by an entity that contracts with the state, or is employed by a temporary placement agency. If you are a SLIP retiree from the judicial branch, contact your district court administrator if you have any questions about reemployment. Check with IPERS regarding rules about returning to IPERS-covered employment. If you become ineligible for IPERS, you will also be ineligible for SLIP. A retiree is eligible to participate in the SLIP program until the retiree SLIP account is depleted, the retiree becomes eligible for Medicare, the retiree returns to the state of Iowa in a permanent employment situation, the retiree drops the state's health plan, the retiree fails to pay the retiree share of the premium, the retiree dies before becoming Medicare eligible. The retiree spouse can continue coverage but cannot use the retiree's remaining SLIP balance. Any remaining SLIP dollars left in the retiree's account when the retiree is no longer eligible is forfeited. The employee must be the dental policyholder to continue dental insurance as a retiree. To continue dental insurance, the retiree pays 100% of the premium. SLIP funds cannot be used to pay dental insurance premiums. The spouse is able to continue dental coverage when the retiree passes away, as long as the spouse is enrolled in dental coverage at the time of passing. Additional information about retiree benefits is available on the DAS Benefits website. Type benefits.iowa.gov in your search engine. At the DAS Benefits website, click on Retirees. If you have additional questions about continuing insurance benefits at retirement, contact your agency's Human Resources Associate or email stateretirees@iowa.gov. Thank you for taking time to learn about the state of Iowa retiree benefits.